So today's date, well, yesterday's date was the 19th of March, Thursday. Of course, we will be dissecting this move over here on the US30, but this is a very good example of how institutions trap traders, whether it be convincing them to get in a trade by creating inducement, and of course, timing, which is extremely important. Okay, so on a basic framework, let's say for instance we are looking for a sell, okay, and it is advised to be taking a sell trade when the market is in a downward momentum. Okay, for instance, a downtrend. When the market is trending upwards, you can take a sell, but you know, for consistency purposes, and if you are a relatable trader when it comes to trending, taking a trade with the trend, of course, then this is going to be perfect, right? But here's the thing: if the market is trending to the downside and we are looking for a sell, if we take US30, okay, when is the best time to be taking a trade in US30? Well, you have to wait for the New York session open, okay, the New York Stock Exchange open. And the time for the New York Stock Exchange is, well, if we go here to my time zone is UTC +2, okay, but that would be 3:30 in the afternoon for me, and for the EST time, I think that is around 8:30. Now that daylight savings occurred just recently, I think on 9th of March, and then for another portion of the year, it shifts an hour later to 4:30 for me, and then 9:30 EST. Okay, that is the exact opening. Okay, so for instance, if we're looking at this framework right here, if we're looking for a sell, understand that, let's say for instance, this vertical line is the representation of the open. Okay, just make this a little bit bigger, just like that. When the market, let's say for instance you're a advanced or experienced trader, you take a trade when the market maybe retraces, taps a order block or fair value gap, and then you take your sell trade right here. Okay, stops maybe above the high, and then price moves a little bit in your favor, and then as let's say for instance we are aiming for this low, and then the market opens exactly at 8:30, right, which is the New York open. The market then pushes up, stops you out, and stops all the other traders that have gotten in before the timing window. Everybody gets executed out, and then boom, the market continues that underlying trend. Okay, this is very important, which is of course timing. So always wait for the market to open the New York Stock Exchange before looking for a trade on US30. Okay, that is a prime example. So let's move on to the practical that happened right here. So the indicator I'm using here is the trading sessions indicator. The way you get it is indicated right here on trading view, and then this is the one right here, trading sessions. Click on it, and then of course you can edit it right here. I only have the third session showing, as you can clearly see, 9:30 to 2 o'clock. Alright, and then the shaded area here is basically the New York session, and of course this is the opening candle right here. This is a 5-minute chart, of course 15-minute, and as you can see, these are all the sessions that happened in the past, right? So when you're taking a trade in US30, it's always best to of course have a trade executed when the shaded area is open. Okay, so let's explain the price action on today. So first things first, my bias. Okay, I saw that of course for a very long time we clearly see that the US30 has had a massive impulse to the upside, and then it shifted now to the downside, and it's pushing pretty rapidly for about a month now, from this point, and now we are here. So my bias is sells in this moment in time. Nothing too crazy, I don't have trend. I can, throw a trend line, maybe like a ray right here. That can easily just point me in direction, but I know just based off of momentum, seeing how the price is moving, it would be best to be taking a sell in this moment in time, especially if we are, market push down, push past these lows right here, and of course also push past this low. So market is just rejecting. Okay, so it would be crazy, or it would be weird to be taking a buy trade from this point, even though we could easily push from here. But remember what I just said, we are approaching, in this moment in time, I saw the 4 hour, we had massive downward momentum, and I moved down the time frames, right? Because now, since we are approaching the New York Open, where will the institutions likely target before continuing, the overall trend, which is down? Okay, so when we are approaching the New York Open, okay, let's say this line over here, when the market opens, okay, before they continue the underlying trend, they like to target liquidity, okay? And because we are pushing down, the relevant liquidity is of course the lower highs. Okay, here is a lower high right here, a lower high right here, a lower high right here. Okay, and what time frames? Well, it doesn't matter. They target 5-minute liquidity lower highs, 15-minute liquidity, 30-minute, 1 hour, 4 hour, all time frames. Okay, but you need to understand that when the market opens and they push, they grab this 5-minute over here. Let's say it's 15-minute or 1 hour, doesn't matter. It pushed up, grabbed the high. This is the best time now to be taking a trade, because liquidity got captured, and then there's a very high chance that you might not be the liquidity anymore because they already got trapped. There's orders available in the market, and then you take a sell after confirmation. Okay, very, very simple. So now you know the time frame liquidities you need to be looking for. Doesn't matter, 5-minute, 15-minute, 30-minute, 1 hour, doesn't matter. Okay, now even if the market pushes up and just grabs this liquidity here, it's fine to take the trade. The market doesn't have to push up and grab all of them. Okay, just remember that. Let's keep that in mind. Okay, so now we know, okay, in this instance, on the 4 hour, so I think the open was somewhere here. Okay, where is the recent liquidity on this 4 hour? The recent liquidity, because we're pushing down here, is a lower high right here. Okay, that's liquidity there, and then here is also liquidity right here. Okay, but we have to be realistic here. Okay, yes, we can plot it down and the market can easily push up and grab it, but when we push down the time frames, we can clearly see that, okay, this is where the opening is, okay, and this is where that 4 hour liquidity is. Are the chances high that they will push up and grab this liquidity? Yes, it is, but there is more liquidity available on lower time frames, which is much closer to the relevant price right here. Okay, for instance, here we have this lower high on the 5-minute. Okay, but this liquidity was captured before the open, as we can clearly see. Now, do we take a trade here? No, because there's a very high chance that if you take a sell here and you maybe, aiming for, a specific target, like, 1 to 2, whatever, depending on the time frame you're entering and your candlestick confirmation. If you enter before the open here, you can clearly see that these early enterers, these early traders that got involved here, got captured by this push up, and here you can clearly see this was the overall move for that session. Okay, now this is liquidity on the 5 that I've seen. This is also 15-minute, which was this one. Okay, let's see on the 30. 13, no. Okay, so this was the one that was available in the 30, but again, like I said, you have to be realistic. Okay, look at the closest ones. You don't have to plot these ones here that is much further from the price. Okay, it's very seldom that if they do grab liquidity, which was this high over here, that is more than enough for them to push down. Okay, so here the market opens. Remember, we're not in the market yet. Market opens. Okay, market pushes up, grabs this high. Okay, all the traders that got involved here got stopped out if they did not partial or close their trades. So in this instance, we can take a sell, right? So how do we get involved here? Well, we can also see that we can combine liquidity with a SMC concept. Like, let's say, for instance, here we see a fair value gap or fair value imbalance available above the liquidity. We see a 5-minute order block right here. Okay, if we go to the 1 minute, we can see that they pushed up, grabbed the liquidity. We can see a 1 minute order block right here that the market refused from. Yeah, very, very simple. It doesn't really matter what you use as long as that the timing phases and the principles, like I explained earlier, were accepted, right? So here, when the market pushes, grabs the liquidity, do we get involved immediately? No. You first want to wait for the market to confirm the move. Okay, here on the 1 minute, we can clearly see, the market gave a breaker structure off of this low right here, already indicating selling pressure. Market push, even this alone is maybe good enough for an entry. All right. And if you're a more advanced trader, you could let them break structure, push up one more time, grab the liquidity. Okay, grab liquidity on that 1 minute, re-enter that 1 minute demand or supply, take an entry right here with a much better stop loss, and then we can clearly see this would have been a much better RR for 1 to 5, 1 to 6. Of course, trailing your stop in an instance like this is very important. Okay, so yeah, that is basically the video for today.